All right. So midterm's over. First thing I'm going to do is review the questions on the midterm. It ought to be pretty straightforward. I mean, you had a pretty good idea of what was on the exam. I hope most of you did pretty well. I'll be going back through it and uh, grading whatever homework came in at the last minute there. I got most of it done, but still some to go. Um, so opportunity cost. We talked about this before. Opportunity cost is relevant to personal finance. It's relevant to everything. If you're watching TV, you're not reading a book. If you're blowing money on whatever, you're not um, using it for maybe a better purpose. So anyway, what you give up to forego as a result of making a decision. Um, Another one on opportunity cost. So giving up a movie in order to study for. Well, that was easy. COVID helped you with that one. Maybe giving up Netflix, I guess. Retirement planning should begin as early as possible. So, really, it's the time value of money. I mean, if you go back and you look at those charts and you really dig deep in those charts that we talked about the first day, I mean, you can see that a tremendous amount of money is required later in life to catch up to what could have been done with very small, even by a percentage basis, very small percentage of your income if it's done early in life and has time to accumulate. If spending exceeds the amount of your income, yep, best option. You got to learn to live within your means. I mean, that's really the truth. So, I know it's difficult, but if you set aside a portion of your income and especially doing the pay yourself first, just don't act like you have that money. Take that money out of your account, from the first part of the month, just like it's another bill, and you'll learn to live within your means. All right, liquid asset. So cash is definitely liquid. Real estate, the other extreme, not so much. Stock held in a retirement account. Well, stock, you know, liquidity says nothing about the wisdom of selling it. So that's a problem with stock. Stocks go up and down, and you may not want to sell it. You can get the money in a couple 3 days, but if it's a retirement account, now you've got another problem because retirement account, IRA, 401k, there's a automatic 10% penalty imposed by the IRS unless there's some sort of hardship or you're 59 and a half or older or whatever. Plus they add it onto your income, so that's not a good option. Real estate, we know that's not a good option. Student loans, housing, long-term liabilities. So again, student loan, that's kind of investment in your future, but you know, make sure you minimize it. There's a lot of politics that goes on with that now. It's a federal program, so you do see a bit of control, especially when it comes to elections. Somebody who says they're going to forgive it, but I guess that's not the case right now. Car loans, housing loans. So anything over a year is basically, and yeah, a liability means money you owe. The best measure of a person's family wealth is net worth. So that's, you get your assets minus your liabilities. That gives you net worth, the difference between those two. Monitor your debt level because you need to be able to cover your monthly payments. If you get that far behind where you absolutely have monthly payments, and creditors will let you do it. Um, maybe not on a house, they won't. They might get close, but some of the more predatory, car loans and stuff like that, they'll give you a loan. They'll just boost the interest rate and they'll get you in a position that, essentially your bills are more than you make. Money you received is worth more than the same amount of money in the future. So that's compound interest. So, we keep talking about compounding. Compounding means earning interest on interest. Time value of money, same. Worth today is received more than um, one tomorrow. So $100 today versus $100 a year from now. You can turn that $100 right now into a little bit more. Earning interest on interest is compounding. Qualify for head of household. Obviously, be single because if you were married, you'd claim that status, um, and have at least one dependent. Be a homeowner. No, homeowner is not an issue. So A and B. Disadvantage using credit. Yep, if you can't make that bill, I mean, credit card charges, they're in the 20s generally. It's horrendous. Stopping payment on check. Again, typically now used for lost checks and stuff since most checks are processed electronically. Once you've given somebody a check and they've taken it even to a grocery store or bank or something, it's going to process electronically and there's no more float. Float used to be the time that it took for the check to be transported to the check cashing facility. Um, Overdraft protection. Yep, protects you when you overdraft your account. Typically, it just rolls onto a credit card. So, good situation because it doesn't, incur a bunch of fees and charges. Reasons to borrow funds. Yep, medical emergency, certainly college education to a certain extent, and yep, an asset that's going to help you make money. But yeah, day to day, if you're borrowing money for day to day expenses, you got an issue. Pay off the balance every month makes your convenience easier, means that you won't pay any interest at all. Credit card companies still going to make their money. I mean, they're going to make 3% off the merchant, but the way they like to do it is make 3% off the merchant and then a bunch of money off the person who lets their bill get out of hand. Which is not true. So if you ever use by mistake, use a credit card in an ATM machine, you will find out that there's a huge difference. They start charging you interest from day one. There's no grace period, no paying off the balance. And there's also typically a, charge just for doing that cash advance, 10, $20, something like that, if not more. But they can be useful, used wisely. And especially, if you're trying to shop for anything, you're trying to get a hotel, a rental car. If you don't have a credit card, you don't have a rental car, you don't have a hotel for the most part. Or if you do, it's going to be very difficult, and they're going to want to know, if you're traveling and you don't have a credit card, you're going to call all sorts of unwanted attention, and people will judge you. Finance charges apply only to balances not paid in full. That's true. APR, annual percentage rate. Credit card statement. So certainly, and again, I use this more of a budgeting thing. If you look at your credit card statement, all of a sudden, you notice the balance is racking up. It's like, wait a minute, what am I doing here? Where's all this money going? And you may find that, yeah, you just had some unanticipated expenses, but you also, in the process of that, can look for other charges. Collateral gives the lender recourse if payments are not made. So this is a good thing, A happy lender is a good lender because they're going to give you a lower interest rate. If you have an unsecured loan, it's going to have, a pretty high interest rate. Um, so secured loan and collateralized, those are basically the same thing. And that's why it's a lower interest rate there. If you're a cosigner, you are responsible for that loan. And obviously the person who needed the cosigner is, at least on a financial standpoint, kind of flaky and needed a cosigner. So bill collectors are generally not going to pursue them, but they will pursue you because you co-signed it. You obviously had the assets to get the loan. Purchasing a home, you don't pay the commission. The seller pays the commission. Homeowners Association, one disadvantage, I could give you about 20, but anyway, covenants, big deal. They'll limit the way, and sometimes it's good, sometimes it's bad. It will definitely, most cases, prevent your neighbor from painting their house, bright orange or purple or something like that. But it may also, prevent you from painting your house a a little shade of some other color that makes it look just slightly different than the rest of the neighborhood. That may not be allowed. Fixed mortgage rate, monthly payment will stay the same for the course of the mortgage. So 30 years down the road, when that money is probably relatively insignificant, payment will still be the same. ARM, adjustable rate mortgage, and that means a loan that you take typically for, obviously it's going to have a lower interest rate or you wouldn't be incentivized to do it. It's going to have, say, interest rates are 3%. An ARM might be, 2 or 1.8. But there's, an understanding and also a legally binding contract that you sign that says that that rate may go up if interest rates go up. And just depends on the situation. Sometimes it's smart, but for the most part, not. Ignoring risk is not a risk management strategy. So try to avoid, accept, get an insurance company, which is related to insuring against risk. Comprehensive coverage is kind of the cats and dogs stuff. Wind, hail, things like that. Non-driving things for the most part. Windshields, though, fall in that category. So a deductible is the amount you pay. So standard homeowners policy, obviously flood insurance, we've talked about that. The whole concept of insurance does not work when everybody or nearly everybody has an issue at the same time. So that's why that's a federal program. Valuable property needs some sort of policy identifying it, called a floater, called a rider, what have you. But it needs to be identified so that make sure you're covered. Homeowners deductible or homeowners premiums, best way to reduce it, increase the deductible. Obviously, if you have a $1,000 deductible, you're not going to be generating a bunch of paperwork over small things, and you're gonna save your just from a paperwork and management policy. Having a high deductible simplifies things for the insurance company. Health insurance is expensive, and that's why most, like almost 80% of the folks, somewhere around that neighborhood, maybe 80 is a little high, but certainly 10 times the number of people in Obamacare or Affordable Care Act have insurance provided by their employee or employer. All right, so that's the review of the exam. Let me know if you have any questions, but it should have been pretty straightforward. From that, we're going to jump right into life insurance. Now, first, philosophically, life insurance is it's kind of a minefield, in terms of a lot of misinformation. And if you do get information, it may be offered to you by a salesman who obviously, doesn't have your interest at heart. So there's a lot of misinformation out there. The best way to think about life insurance by people, and if you can get somebody's opinion who's not on commission, who's, giving you, looking truly at your best interest, life insurance is a temporary need, right? You don't want to, in my case, I certainly don't want to die with life insurance because, even I'm not that old, but I've made it to a point where that period of my life where I required life insurance has passed. Life insurance is for the people you're leaving behind who need some sort of, something, a boost or something, well, whatever, the void that's created when you passed away. What you want to do is, at least financially, fill that void with the cash that you would have earned. Well, when you get to a certain point, most of those requirements or those obligations that you had for people depending upon you, like say, a non-working spouse who, would need to go back in the labor market if you passed away, or your children, who want to hopefully still go to college or have that money that you would have set aside for them, or leaving your spouse or whatever with a huge mortgage. All those things can be filled in, and you can be made whole with life insurance. But once you get to a certain point in your life, those things are kind of, you know, they either happened or it didn't happen. You know, that your kids either went to school, you probably had a 30-year mortgage and it's probably, nearly paid off, and you may be getting close to retirement age where you weren't going to be generating a whole bunch of income anyway. And rather than, because life insurance is just like any insurance, the smart people, who set the rates, they calculate it based upon, your propensity to die. And when you get older, those rates are going to be pretty high because your propensity to die is quite a bit higher than it was when you're in your 20s. Well, so you could still purchase that life insurance when you're old like that, but it's not a very good investment, and you would be much better off putting that money into, investments or whatever. And if that's what you want to do with it, your kids would be much better served with that nest egg that you generate from your investments than some insurance policy that's going to typically be a much lower amount. Or, maybe you need to start spending on yourself. But to have this life insurance policy, and and this notion that your kids or your dependents win the lottery because you died, that's kind of creepy. So there's different types of life insurance. And what I'm talking about, what I was kind of describing, or at least the insurance that fills the requirement I was talking about, is typically term life insurance. And that's just insurance that you pay for a certain length of time, and you get $1 million policy, and if you're young, that $1 million policy may be $30 a month or something. It's going to be incredibly cheap. Try and do that when you're older, and it's going to be incredibly expensive. But guess what? You don't need it at that point. Then there's also these other complex life insurance policies, and they call them whole life or whatever, and they're like a hybrid investment and life insurance policy. But the problem with that is they're managed by an insurance company, so they're not really a great investment. The yields don't stand up well against typical investments, and they're quite pricey. When you pay for them, and it's just, you would have been better off keeping your investments and your insurance separate for the most part. Again, you can have different opinions on this, but I'll show you a couple videos, and I think you might find the most common advice you would get from people who are not salesmen, people who don't stand to benefit from you having a whole life or a universal life or some complex policy. Um, they would agree that term life is probably the way to go. So anyway, let's look at the basics. So life insurance, payment to beneficiary. We talked about this a little bit beforehand in the previous material. Role of life insurance, financial support for dependents, leave money to their heirs. There might be better ways to do that if you're trying to do that, regular money rather than an insurance policy to your heirs might be better. Um, Life insurance decision. Some people have trouble, focusing on this, I guess. But if you do it when you're younger and you're in good health, it's not quite as difficult. Hard to pay for ongoing premiums for benefit you might not need. Anyway, insurance companies help clients. Well, really, they're in it for the money. Let's not sugarcoat it here. Um, Whatever the type they want to sell you and the type you need may be different. Is my point. Applying for life insurance. This can get kind of weird. If you and I've done this before. I think I've mentioned that I was in the military and flew fighters, and I was actually, in quite a few wars. And in one particular one, we were going over to Kosovo. I was flying Wild Weasels at the time, and there was they had just shot a guy down. And so anyway, we were going over there, and so I plussed up with a couple different policies, and there was a lady who may or may not have been a nurse. Anyway, she dressed up like a nurse and she came over and she wanted to came to the house and to take my blood because they saw me with two or three new insurance policies, each of $1 million. And like I say, you can get them for 20 or $30 a month. So I'll take two or three of those. And anyway, they ask you all these goofy questions. It's funny. Always the typical things where do you parachute, recreationally? Do you scuba dive? For some reason, they always thought that was going to be, but they never asked, hey, are you going off to war next week? And so the question never came up. So I was honest, and they checked my blood, and I didn't keep those insurance policies very long. Once I got out of that line of work, I let them lapse. Uh, anyway, term life insurance. So this is what I was talking about, and that's the type I'd got right then. Life insurance that is provided over a specified time does not build cash value. So paid quarterly, monthly. Again, um, pretty affordable for just about anybody. Now, if you're, somebody who's has nobody dependent upon you right now, you really don't need that insurance, even though it's affordable. I mean, that's not a big deal. Now, you may also be somebody who's got young kids, whatever, newly married, big mortgage, a lot of life yet to go. You may definitely need the insurance. So it depends on your life situation. Detriments of term: the longer the term, the higher premium. Go figure. Older the policyholder, higher the premium. Certainly, that's true with any insurance, though. Greater the amount of insurance cover, that's only fair. Premiums higher for male than females. Well, any insurance policy. Males tend to, do everything from falling off roofs to whatever. They just tend to die more. Higher smokers, you knew that. And medical problems, certainly, if they'll even grant you the insurance. So that's what happens. And that's why, hey, I'm cruising along. I'm like 50 and house is pretty much paid off. You know what? I'm good. I followed that little chart from day one, and I may not quite have my 5.2 million yet, but I got a million or two, and I got, these guys want $1,000 a year for premiums now. I think I'm going to put that in investments, and that $1,000 a year, will generate a lot more than that insurance policy because, you're kind of betting on yourself that you're hoping. The only way insurance policies pay, and especially term, is if you die. There is some cash value in some of the more complex ones, but like I say, they're investment policies, and generally, it's not as good an investment as you buying some sort of asset with that money instead. So 25-year-old, 40-year-old, yep. Smoking, non-smoking, females, males. So kind of the risk groups that are going to go, and this is completely fair. I mean, they're not being mean. They're just saying, yep, you. Plus, it may be associated with other things. I don't know. They may not have questions about doing other lifestyle things, but a smoker maybe in other behavior. There's a lot of these tests, a lot of these studies that are just completely, they don't do them very scientifically. For example, they found that um, cocktail waitresses, or at least they found that loud music caused cancer, and they had some association. And they went back and looked at it. Yeah, what they did was they sampled cocktail waitresses who worked in places with loud music. Well, this was back in the day when people would smoke inside as well, and so it probably wasn't the loud music. It was probably being in a smoky environment the whole time. But anyway, you have to look at the causal factors and the rest of it. But um, insurance companies may not care. They just say, hey, from our studies, people who are smokers, maybe based upon that individual behavior or the associated things that smokers run into, we just know they're going to die earlier, and we're gonna charge them more. They don't care. Decreasing term, you can do it that way, where you keep the payment the same, but the um, amount of money that you'll get. It's $1 million policy when you're 30, By the time you're 40, it only will pay 500,000, but your policy stayed at 20 bucks every month. You can do it that way. There's also these mortgage life insurance policies, and you'll see them sometimes credit life insurance policy. And again, I think I mentioned this before, and this is smart for the insurance companies or the mortgage companies where incumbent or inherent in you taking or included in you taking this policy is that you sign up for sort of a mini life insurance policy associated with that debt. In the event of your death, that debt is paid off by that little mini life insurance policy. And mortgage companies like that because they don't have to wait on insurance proceeds or no proceeds at all. Your note is paid in full upon your death, and so they'll probably weasel around where you're actually paying for it anyway. So that's works for them. Group term. So just like we talked about with healthcare, group policies, uh, insurance companies are very sensitive to, outliers, to somebody with extreme behavior. They like a larger pool because it gives the distribution makes it a little bit more normal. Anyway, typically employees are used as that group though. Whole life insurance, permanent life insurance, all these terms you can just tell that they're very ambiguous. And it's kind of a rebranding effort. When somebody says, "Well, I hear whole life insurance isn't good." Oh no, that's we've got permanent life insurance, something different. It's anyway, life insurance that continues as long as the premiums are paid, so you can keep. You will have a benefit upon your death at even old age. Not only provides benefits to the beneficiary, but also has a cash value. So you can tell in that fact that it has a cash value that it's not truly an insurance policy because it has value without you even dying. But let's say that $1 million policy, for a very young person is 20 or 40 bucks. This policy is 500, 600 bucks. So it's quite a bit more money. And using time value of money, like if you're say in your 20s and you're plunking down $600 a month for a life insurance policy versus the person who's plunking down $20 and putting 580 in investments, that guy putting the money in investments is going to be way ahead at the end of the day. Now, if the $20 guy is spending the rest of that money on, junk, then yeah, maybe this forced savings plan is going to be useful for you. But um, forms a whole life. So any of these policies, these whole lives, they require a salesperson. You can go online and you know do a little calculation, figure out what kind of term life insurance you want, find a carrier, do a little research, and just knock it out on the internet yourself. It's like buying a plane ticket. These other ones, they won't let you do that. You have to, you know, use an agent and the rest of it. And, it can be a very, drawn out process. Comparison to term, whole life has higher premiums, like by a factor of 10. Accumulate savings, yes, but the uh, investment, the interest you're earning on those savings is generally not competitive with other forms. Premium remains constant, so uh, will not go up typically, but again, that can be structured differently. Universal life. So again, where's universal? Um, anyway, accumulate savings. Variable life. This one has stocks in it, and again, these terms are marketing terms. So New York Life's variable life versus Mutual of Omaha's variable life may be different. So that's why these definitions are not that valuable. The broad category is, I guess, term life insurance, which is simple, easy to explain, and then everything else, which they would typically call permanent or whole life insurance. Determining the amount. there's easy ways and hard ways. But if you think about it again from the standpoint of how much insurance do you need if you were to, pass away an untimely death, um, and think about what needs to be paid for. But this whole thing, 10 times your income. So the guy who's making, 100 grand and has no kids is, I would argue, a completely different situation from the guy making 100 grand and has 6 kids. So I don't see the value of this one. Easy, but doesn't consider. So easy slash worthless, doesn't consider individual circumstances. Budget method. So this way, annual living expenses, debt, job marketability of spouse. Is your spouse college educated? Can they, within a year or two jump into a job, or are they not employable? Value of existing savings. So this, it takes a little bit more, but it's going to get you closer. Um, internet to, well, that's just silly. I mean, these guys again, they're enamored with the internet, but there are things on the internet that will help you, you know, calculate your needs assessment. Limitations on estimating need. So certainly could be other factors in there. Family income may not rise. Weak economic, inflation. Anything's are going to happen. This is living or dead. You're going to have those type of situations. What you need to do is you need to use some type of method similar to this, calculate out what it would cost, and it may be a very high dollar figure, but that dollar figure should decrease over time. And literally, when you're in your 50s and 60s, and then insurance starts getting prohibitively expensive, you can just say, you know what, I'm good, and be done with insurance for the rest of your life. Um, Life happens. So again, you're going to get free apps. Free anything is, a lot of times, they're either getting your information or they're steering you towards a product they have. Um, but when you are doing your term project, which we'll also talk about, there's a lot of these mutual fund companies that have, a broader, they want to be kind of your personal finance people, and they typically are not associated with some of those more complex products. And they may actually have, since they're not selling a product or they're selling a product without commission, you may be able to get better information there. And you've already given them all your information by starting up an account. So rather than just going to, something.com, you might actually check with whatever financial institution you set up your 401k, or you use that stuff with. Now again, for the project, it's not necessarily that you have a login. They've got plenty of free information available on, say, Fidelity, Vanguard, T. Rowe Price, any of those sites. Okay, needs and dreams. Yeah. So again, depending on what needs to be covered. Um, Beneficiary, that's the person who's getting it. Grace period. Sometimes there's a period before it kicks in. Living benefits. Let's say you're diagnosed with a terminal illness. We know you're going to die. It's certified by a doctor, and they're about to take the house because you're stuck in the hospital. Well, perhaps on some of these policies, you can, actually get a portion of that life insurance money before you pass away to cover that, which is nice. Non-forfeiture clause. That has to do with whole life policies that have a cash value. Again, term does not. Loans, taking a loan, there you cannot take a loan against a term because it does not have cash value. And contestability. Typically, after a couple of years, they can't fight about, he had a pre-existing condition he didn't tell us about, he lied. Now, at a certain point, they're all in. Renewability, that can be kind of important. If you're doing term life and you want to make sure that you're able to get renewed, you may want to look pretty hard at this option because let's say you do develop, whatever, diagnosed with diabetes or cancer or something, and next time you go to fill out your term life application, and now you're somebody with a pre-existing condition, so you may want to check into the renewability of those options. Conversion, term life into whole life, oh, they'll definitely want to help you out with that because the amount of money they're going to get is going to be considerable. Settlement options, kind of like a lottery, a lump sum or annuity, a series of equal payments. Oh, there we go. So they call it installment plan here. In other places, you'll hear an annuity. Annuity is stream of equal payments, which by definition is an annuity. Annuities are kind of cool too. Annuities they'll actually do sometimes as a separate insurance policy, or it's not really insurance, but what this is like I talked about. In insurance, you got to die to get the money. With an annuity, it's a system. Again, it's kind of a complex product, so you got to go to an agent typically to get it. But let's say you give this, you set up an annuity, and in this scheme you give the company $10,000 and they start making $100 a month payments to you. That's the deal with this annuity you signed up for. And guess what, if you die next week, you gave them 10 grand and they only gave you $100. But if live 50 years more and they gave you $1,000 a month forever. Annuities are nice because you're betting on yourself living. Insurance, you're basically hedging your bets that you may die. Annuities are more positive. So anyway, interest payments, settlement. So that's a different way of doing it. Pays the interest to the annuity, to the beneficiary. I'm sorry. Selecting a life insurance company. So different companies, when you're looking at different investments, bonds, mutual funds, different companies do different ratings. And AM Best it's a private organization, but they do the financial ratings for insurance companies. So you want to see a high rating comparatively, and so compared to the other insurance companies, or at least not well below. So because ultimately, when it's time to pay out, the insurance company needs to be solvent, and so that's why it's important to deal with a company that's pretty well. And most of the time, you don't hear about insurance companies failing, but they most of the time are not involved in very risky investments at all. So you're kind of in really slow investments if you were to use the whole life, universal life, one of those type of things, because you're not in aggressive investments that you probably should be in when you're younger. Okay, investing fundamentals. We'll run through this pretty quick. Um, Personal balance sheet. Yeah, you need to be more or less debt free of high interest debt before you start investing. People who are making payments on their credit card and trying to invest at the same time, you need to pay off your credit cards first. Don't spend yourself, don't, invest so much where you have no money. But if it's an investment and it's a liquid investment, I wouldn't worry too much about that. Money markets. So money markets are kind of a parking place. Money markets are typically government securities. They're going to do better than bank rates, but not much. But stocks generally, over the long haul have been shown to get about 10%. And like I say, some couple of these past years, you get 30, 40%. It's amazing. But, that won't last forever. But it doesn't need to last forever as long as it averages out to about 10% of the year, 10% a year, which it's done since the turn of the previous century. Long track record. Anyway, common stock, preferred stock, don't get wrapped up in that. Not a big distinction there. Um, Absolutely not a distinction for me because I don't invest in stocks that typically pay a dividend. And so the only difference between common and preferred As a preferred stock, um, if a company's sketchy, and I don't invest in sketchy companies or companies that are not doing well financially, they may not be paying a dividend. And if they're in that sort of position, well, first off, why would I have that stock? But let's say I do, and if I had the preferred stock, well, then I'd get a dividend before the common stock guys would get their dividend. I'd have first right at the dividend, but I don't want income stocks, and I don't want to invest in companies that are not doing well. If I did have income stocks, I'd want a company with a track record of always paying the dividend, because that's you have two broad classes of stock, right? Stock means an equity position in a company. You actually own a little small chunk of that company. And if it's a small company and they're making money, the reason why they're selling stock is because they're trying to grow, right? And any money they make, any profits they make, they use that to grow their business further. More developed companies that have been around a while, with their profits, they tend to return those profits to the shareholders by way of paying a dividend. And so that's an income stock. Um, but those stocks, since they're more mature like that, are typically not going to have, you know, the rapid growth that the smaller ones would have. There's two ways to make money with stocks, and one is um, just getting that dividend. Let's say it's 3 or 5%. Getting 3 or 5% on your stock every year is, you know, not bad. The other way to make money on stocks, though, is to buy, buy low, sell high. So you start buying the stock at 20, and now all of a sudden it goes to 30, or going something like that. And when you sell those shares, you get that difference in price. So we'll talk more about it as we go. Um, Primary and secondary markets. When you buy stocks, like let's say you buy some stock in Ford Motor, you're not buying it directly from Ford Motor. Um, there are sometimes direct purchase programs where you actually buy from the company, but that's very rare. Most of the time, stocks that especially individual investors buy are stocks that are on the secondary market. And so but it's not like a car. I mean, it's not like used stock. It's just stock that's already been issued and is in the market. Sometimes you can get into the primary market if you do that, an IPO, an initial public offering, when a company goes from being private and they decide we're growing, we need more money to expand, we're going to generate money by selling stock, and we do a initial public offering. So, Facebook did this years ago, and other companies will do this. The problem with this is it's kind of a rigged game. Unless you're connected, unless you're a big, you know, pretty much not an individual investor, you may not have access to the initial public offering. There's nothing fair about the IPO process. They don't have to offer it to everybody. No, they can give it to their better clients, and then you can buy it, right after. Buy it from one of them, but the price may have changed dramatically by that point. So IPOs can be exciting, but it's tough to get in them. Um, so secondary market, that's where most of the stocks are traded. So New York Stock Exchange, Nasdaq, something like that. That's where the stocks are traded out there. It's fairly transparent to you. Doesn't matter. I buy some stock every month actually from the company I work for, and I don't necessarily want that company stock, but they sell it to me at a 5% discount. And so, showing my extreme loyalty to the company, I turn around and sell it immediately. Like literally every quarter, they settle it out, and I sell it like within the next day or so. And assuming the stock price is, you know, not gone up or not gone down, I'm making 5%. So it's not huge money, but I think it works out to about $700 a year of profit just by doing that. So again, you're kind of leaving money on the table if you don't. Types of investor, institutional investor. So when you say, oh, the corporations are ruining it, the corporations are owned. They're owned by shareholders, right? And the shareholders are probably you. If you're invested in a pension plan, if you're, work for whoever. I mean, the PFD is invested in stocks. It's an institutional investor. There's, school teachers, all the different unions have pension funds. They're all investors. So anyway, it's kind of funny when you hear people talk. You can tell they really don't understand how, what organizations do with their money. Portfolio managers, these guys may be like the brokerage companies that have mutual funds, and so they've got a whole bunch of shares of companies, but they may not have, a union or a state fund or somebody behind them. And then individual investors, we're just a small group. And most of the time, you may find yourself in a couple of these groups because, by the terms of whoever you're working for, you may be in their, whatever mutual fund or whatever pension plan, and then you may be able to get part of it self-directed. And if you're self-directed, part of it may be individual investors. Day traders, that's kind of a gimmick. Um, there are some people who, especially when the market's really volatile and going up generally, there's a bunch of people who convince themselves that they can make a lot of money by trading, in the day, and they're just, in and out of trades. And it's a lot of whatever. But you see some of these guys, it's almost like some of the professional gamblers where they've got a bit of a system, but they're working on such a small margin that they're risking a lot of money and they're getting not a great wage, not a great return for the amount that of risk they're exposed to. So um, anyway, if you're interested in doing that, there are some good guys, but there's always every time the market takes uh, a dip, there's a lot of those guys who become former day traders. Bonds. So bonds, I talked about stocks being an equity position where you own a chunk of that company. If the company goes out of business, you can't say, "Hey, I want my money back." No, that was your company. You owned a chunk of it, and it's gone, and so is your stock. Now, a bond is a loan. A company, let's say they're growing again, and sometimes it's government or agencies and stuff who can't sell stocks. They can't sell part of their stadium. That's public thing, but they do need a loan to get that thing going. And rather than take a loan from a bank, so there can be government bonds and corporate bonds. Anyway, if a say for a corporation, they decide they don't want to sell stock and they decide to do a bond offering, all they're really doing is getting a loan from you. Let's say, they sell a bond. It's a $20,000 bond of 20 years. And that means that you give them, some of your money, your 20 grand. And at the end of 20 years, they give you your 20 grand back. And oh, by the way, they give you a bit of interest along the way. So they'll give you some sort of dividend along the way. Maybe, let's say $500 a month or $500 a year. And then at the end of the time, anyway, I'm just grabbing these numbers, but so there'll be a series of recurring payments to you as the bondholder, and then there'll be the return of your money to you at the end of that term. Now, just like stocks that are sold in secondary markets, bonds can be sold in secondary markets. So let's say the likelihood of you actually keeping this bond for the full 20 years, you don't necessarily need to do that. You can sell that bond in the secondary market. But because there was an interest rate tied to that bond contract, when you go to sell that to, another party, and let's say it was a $20,000 bond, it may be worth more or less than that $20,000 based upon whether that interest rate is competitive. So if they're issuing new bonds, let's say for you've got a bond that pays 3%, and all of a sudden bond rates go up, and now they're issuing a bond that pays 4%. Well, nobody wants your bond that's only paying 3%, so they won't pay you 20 grand. They'll give you 19,000 for your $20,000 bond. Now you can be stubborn and say, I'm going to hold on to it. I'm going to get my whole 20 grand back. And by doing so, there's a bit of opportunity cost involved to you since you decided to keep it and you're, only getting a 3% rate, whereas you could be getting 4%. Anyway, mutual funds. Mutual funds they can be comprised of a lot of different investments, but the concept of mutual fund is to basically uh, diversify. If you own stock, let's say in uh, pick a company, like let's say Apple, and or probably a better example because Apple's pretty dominant and pretty unique. Let's say hard drives or something like that, and you own a bunch of stock in Seagate, for example. If Seagate goes belly up, your investment is gone, right? Now, it, you know at least for the time being, let's say they're both solid state and you know traditional hard drives, you know that there's always going to be a need for hard drives, and you think the tech sector in that particular area is going to go up, and so but you don't have confidence in necessarily which company, or you don't have the desire to try and pick which company. You could buy a mutual fund company that invest in the tech sector and owns a bunch of hard drive companies. So they, Western Digital and I guess Samsung or Hitachi or whoever, all the other companies, and you could buy a little small investment in every one of those companies. And now, as long as the tech sector goes up, your investment will go up. And if one of those companies happens to go out of business, the other companies will take up the slack. If Seagate's not making hard drives anymore because they're out of business, then people are going to have to buy more Western Digital, and so the net exposure to risk for you is diminished because you've got a more diversified portfolio. So you invest over, and it can be configured however the bond is or the mutual fund is set up. It doesn't have to be, but you could buy mutual funds in pretty much you know anything you can think of. There are actually more mutual funds offered than there are individual stocks, meaning there's more mutual funds than there are companies that are publicly traded. So let's say you have some reason to think that Vietnam is the next big thing, and you want to invest in companies in Vietnam. Do not go to Vietnam to do this because the currency rates, the travel, everything else is just going to be horrific. But you can find a mutual fund company out there that has a selection of companies, with businesses in Vietnam, for example, and you could easily invest in that, on your own computer and denominated in dollars and the rest of that, and you could easily invest in that. And so the mutual funds are pretty interesting. And again, there's that ability for those things to be bundled together, and also the ability for your risk to be mitigated by diversification. So anyway, mutual funds are complex, but they're it's a broad range of things. There is not just one mutual fund. There's zillions. Other things, index trading. We'll talk a little bit more about that in one of the podcasts. I'll have you listen to it. But what's happened a lot of times is um, when the market's just going up in general, rather than picking individual stocks or individual companies or doing a whole bunch of elaborate trades. Um, some investors have found that just picking a entire indice, a whole group of stocks is easier, and again, it provides more diversification. It's more complex, but I've got a podcast that explains it pretty well. Real estate, always a good way to do it, and obviously your own home ought to be right in there because that is definitely something you can enjoy. Investment return. So I talked about this before. The two ways you're going to make money: dividends, so a certain percentage from an income stock, an old established company that's paying a dividend, or price appreciation. You buy the stock for $20, you sell it for 30. So growth stocks, price appreciation, right? Substantial growth. Income stocks, dividends. We talked about bonds, how they're going to pay, coupon payments, and bond price appreciation. It could be bond price depreciation too, depending on how that works out. Depends on the interest rates. Mutual funds. Mutual funds depend upon the underlying asset. If they've got some dividend paying stocks, you'll make some money that way. If you buy the shares for a certain price and sell them for more, it's the same. Mutual funds are not necessarily a different animal. They're derivative of what the underlying investment is. In real estate, rental income, price appreciation, perhaps. So if that doesn't, sometimes it's a pure price appreciation thing, a speculation bid on raw land. Or if you've got tenants, then that. But it can be different ways. And plus, you can have commercial real estate. You could have residential real estate. You could have, all kinds of real estate's pretty wide open as well. So they try to make what is fairly simple complex. So, they give you a formula here, but basically you get the price you paid for something, and then the price you sold it for, right? Not a big deal. I paid, $20 for it. I sold it for 30. Bada bing, I made about a third on that. Now here, this is just if there's a dividend involved. I bought it for, say, 20 and I sold it for 22. It's probably not going to appreciate much because it's paying a dividend. But anyway, I made $2 per share on just the price appreciation, and then I got, a 5% dividend, so 5% of $20, a couple bucks. So anyway, you add those up. Keep in mind, to be honest here, you should be doing this on a annualized basis. Like I bought some Bitcoin a while ago, and people are, oh man, you made a killing on it. I bought a Bitcoin for $700. I bought two of them actually, and I sold one a couple years ago, and the other one it's probably worth, I don't know, $12,000 now. But I've been holding it for like 3, 4, 5 years. Every year my percentage return on an annualized rate is going down. So you got to keep track of the time factor as well. I'm not complaining, but I should have sold when it was almost at 20 a couple years ago. And I was going to sell at 20, but it got to 19,000 something. Anyway, differing tax rates on returns. So, yep, interest payments, taxes, ordinary incomes, the short and long term. So, held 1 year or less, ordinary income. So, perhaps 28%, whatever tax bracket you fall into is what they're saying. This other one, though, is typically down around 15%, so like half. Whoops. So, and they're just going through the chart. So they're showing about 15%. This guy, they're showing a 35% tax bracket. This is only, you might have to pay a state tax on that as well. Investment income. We'll talk more about bonds and we'll talk more about stocks in individual times. So I'm not necessarily glossing through them. We'll get to it Risk and return. So yeah, if you're in slow, steady stocks, you know, hopefully, you're not as exposed to much risk. But then your potential reward is going to be less as well. And bonds. I'm not a big fan of bonds. I will talk about them more, but interest rates are so low right now that anybody telling you to invest in long-term bonds is probably not somebody you want to be listening to at this point. It's based upon the interest rates right now. Risk and return, yeah, depends on the underlying assets. You could just put in here small stocks, yeah, mutual funds. They could have bonds in them as well. Depends what the underlying asset is. Real estate, all kinds of things can happen. So again, this is one sentence, but in order to determine that is quite involved. Borrowing money to invest. Well, real estate that's the way it's done. Borrowing money for stocks, that's called leveraging. That's typically not a good idea because what happens in there is they don't just let you, take the money as a signature loan. The collateral for that transaction is the underlying stock. And so let's say the stock price starts to plummet, your collateral starts to plummet, and now they want more collateral. And so you get basically a margin call. The brokerage calls you and says, "We need more money to secure this loan." And when you can't meet that level, they say, "Okay, fine, then we're selling." And they sell you out at the bottom. And yeah, it's a recipe for disaster. Okay, and then the term project. So, term project, it's been kind of a long night because we started with the test. I'll go through more of this. We'll talk more about it in the upcoming days. But again, customize the project for you to get the most benefit out of it. Um, Everybody's situation is different. I realize that. Don't use your own data, but use data that would be close. So you have an idea, so it's meaningful to you, useful for you. And again, yeah, make it something useful for you, and do some investigation. Having a plan is huge. Just making it up as you go through life is not going to be a good or successful strategy. All right, and that's about it.